Okay, so we'll start with FMP 12 options markets and we'll take forward from introduction to derivatives where we had introduced options earlier. Okay, so we'll see the details in this chapter. Okay, now options, of course, we have seen that there are two kinds of options. We have call option and we have put option. Now, call and put, both options can either be American options or they can be European options. What is the difference? The difference is that American options can be exercised on or before the maturity date. So there is a lot of flexibility with respect to the exercise of American options. Whereas European options, they can only be exercised on the maturity. Okay. Now, most of the analysis that we do in terms of valuation, generally we do it for European options only. Okay. Now, options can be in the money, at the money, or out of the money. This is referred to as their moneyness. What is the meaning? Any option that would give a positive payoff if exercised today. See, payoff, not profit. So when we talk about moneyness, we are concerned about the payoff. Okay. If exercised today, that is referred to as in the money option. Okay. So what will be the conditions for call and put options to be in the money? For call option, the asset price, the underlying asset price should be greater than the strike price. Whereas for put options, the underlying asset price should be less than the strike price. And the math is pretty simple. Okay. So if you remember, the payoff for call option was how much? In terms of S and K, this was the expression, right, for payoff. Max, in fact, I can write the equation. Payoff is equal to max S minus K, comma 0, right? So obviously this expression will be greater than 0 or positive only when S is greater than K, right? This will be positive when S is greater than K. Okay, so that is why for call option, the condition of the option being in the money is S greater than K. And of course, the opposite will be for put option, which can be implied in a similar fashion, right? Next, if suppose it gives a negative payoff, if exercise, of course, in that case, we don't exercise the option. But theoretically, let's say if we exercise the option and it gives a negative payoff, it means that it is out of the money. Okay. So again, if you see this expression, okay, S minus K and 0. If S is less than K, only then this part S minus K will be negative. So the payoff will actually be 0. Okay, but let's say if we exercise the option, even if we exercise, because ideally we should not exercise such an option, that is why the payoff is 0. But theoretically, if we exercise the option, even in this case, then of course it will give a payoff of S minus K, which will become negative. So for call option, what is the condition for this to be negative? If S is less than K, right? Of course, this will become negative if S is less than K. Okay, and of course, opposite for put option. And an option is add the money if it gives a payoff of 0. So can you tell me the relationship between S and K for add the money option? For add the money option? Perfect.
Both are
Very
equal.
good. Yes, correct. Correct. So S should be equal to K for both, right? Okay, now quickly, let's just recollect because we've already done these things in Introduction to Derivatives. So let's recollect the payoff structure, okay? Now let's assume that you have an option with a strike price of 60. Okay. So if you remember, this will be the payoff for a long call. Okay, this is the payoff of a long call. And this was the expression max S minus K comma 0. Right? Similarly, this is another payoff. Can you tell me this is the payoff of for which position quickly? This is the payoff for which position?
Long put.
Short call.
Short call. Exactly. Perfect. So this is the payoff for a short call. Okay. And of course, the expression is negative of the payoff of long call. Okay. Next, this one.
Short put.
Everyone, I mean, more answers.
Short
Short put.
put.
Correct, Aviyank. It is actually long put. Why short put? I mean, if you remember, the short position never used to have a positive payoff. It was either zero or negative. And the reason why we had the short position used to enter those transactions is because they were getting the premium, right? So long will get a positive payoff, right? Short
Sir,
put will
in
be this.
hello.
Yes,
Sir, put means we are going to sell it, right?
yes.
So long put would be we are buying it.
Long put would be put means the right to sell. You are
Yeah.
purchasing the right to sell. Long put means you are purchasing the right to sell.
Okay.
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 So if this is the
So
payoff,
long is the holder and
long is
short
the
is the
holder.
writer.
Correct, correct, correct. Long is the option holder.
Okay. Okay.
Okay.
Got it.
So
And sir,
long
what is this zero
as well as
represent?
long put. Sorry,
What does this zero represent in the
zero.
max? Yeah. Yeah.
Okay. See, zero represents the case when K will be less than S or when S is greater than K basically. Because if K is less than S, this expression will become negative, right?
Yes.
So in that case, what will be the payoff?
Zero.
Exactly, that is what zero is. Okay, so
And
after
one more
this,
question,
yes,
sir, with respect to premium, I had suppose if the option is not
we'll, we'll,
exercised.
we'll, we'll discuss in the next slide.
Okay,
Premium will be
okay,
discussed in the next slide. Don't worry. Okay.
okay.
Okay, so we'll just add some more details with respect to your question. Okay. So you asked what does zero represent? We have done this in introduction to derivatives. We'll do it again now. Exactly the same thing we have done. So this part is basically represented by the first part K minus S. Okay. And this part is zero. Now it is clear what does zero represent,
Yes, sir.
right? Okay. So similarly in other cases, and never forget that long position is okay, it's the option holder. So long will never have a negative payoff because long chooses to exercise the option when it is convenient for the long position. Short does not have any choice. Short must honor the obligations of the long position. Okay, if suppose in case the long position chooses to exercise the option, okay, when it is having the positive payoff, short has no choice but to give in. So short is in an obligation. Long is actually the holder who has the option. So when we talk about option, okay, then we always consider the perspective of the long position first. Okay, and then we decide what will happen to the short position. That is the best way out to start with. Okay, especially when you're starting off these chapters. Okay, so Vedant is asking if we, yes, exactly. Not the broker commission, no, no. Vedant, not the broker commission amount. No, this is a mistake. You are absolutely right. The lines would be pulled down for the long position, and for the short position, they will actually be pushed up. But the premium, correct, correct, correct. Absolutely. Okay, so we'll see that in the next slide. Let's go to the next slide now. So payoff versus premium. Now let's talk about. Okay, I think this was interfering with the screen if I'm not wrong. So this diagram I just show once again. This is the diagram which we have drawn. Okay, and this was the first slide. This was the second slide, sorry. If there is any interference from the dialog box on the right hand corner, I've just minimized it, and this was the first slide. Anyways, so let's now deal with payoff versus premium. What is the profit? If you, in fact, we should write payoff versus profit over here. That will be better. Yes. So profit is actually given by payoff minus premium. Okay. So if you consider the payoff for the long call, so I'll draw it once again. This is the payoff for the long call position. And since profit is payoff minus premium, so obviously the shape or the structure of the profit, of course, it will not overlap completely with the payoff. There will be some difference, of course. And you can see it is less than the payoff. Profit is less than the payoff by this much amount. So if something is less than the payoff by a fixed amount, the best way to represent it in the graph and to understand it is that, you know what we are doing? This is the profit, okay? And we are pulling this payoff curve down by the premium amount at every point, in fact. Okay, so at every stock price, the vertical distance between the profit curve and the payoff curve remains constant. You can check that at every point. This okay, this distance we are talking about, whether you measure it over here or anywhere, or over here, or over here, anywhere. Okay, it stays constant. Okay, anywhere you can measure it. So now tell me one thing, just before I continue. Can you tell me what is the point, which point you can see where the nature of the graph is changing? On the x-axis, tell me the coordinate of the point where the nature of the graph is changing. So first it is a horizontal line, and then suddenly it becomes a line with a slope of 1. But which point that change is happening? S
Strike.
is equal to,
S is
very
equal to
good,
K.
very good, very good, excellent. Okay, yes, Lucky, they are actually parallel curves. Absolutely correct. Okay, these two are parallel because the difference is same. So yes, definitely they are parallel curves. So yes, you're absolutely right. It is actually this point K, or the strike price, where the nature of the curve is changing over here. You can clearly see that. Okay, K, K. So since this distance is uniform across the graph, this distance which is equal to the premium paid, okay, it means that these two are parallel curves. Okay, we can in fact write this also. Okay, so they are parallel curves. Now, let's take an example for profits from a long call. Okay, so we'll just draw the profit curve, only profit curve now. This is the asset price. And let's assume that the premium is $4. So if the premium is $4, can you tell me what is the coordinate of this point, which I'm marking over here?
Minus 540.
Four
Minus
zero comma
Zero.
minus
minus 4, exactly. The y coordinate of this point is -4. So the coordinate is 0 comma minus 4, but the y coordinate is -4. Absolutely correct. Okay, so -4. Okay, just give me 1 minute, please. Okay, yeah. So you've Vedant, you've written -4 comma 0. It will be 0 comma -4. Okay, because we write the, yes, correct, correct. X-axis first and then y-axis later. Okay, so y coordinate is -4, like this. Okay. Now, in fact, in the PDF, I'll shift this -4 over here. Yeah. Now, I told you that the profit diagram and the payoff diagram, there's a difference, right? We pull the payoff diagram down by the premium amount, okay? And there are two regions, right? I mean, the nature of the graph is changing at which point in the on the x-axis? If you take the coordinate of the x-axis, at which point the
At
nature of the graph is changing? 60, right? Okay. So at 60, the nature is changing suddenly. Now, can you tell me if I ask you that, okay, I can write the profit after this 60 as P, payoff will be very clear. Payoff is not a problem. Payoff is simply S minus 60, right? 60 is the strike price. It's very clear. But this is not a payoff diagram, right? So this is not a payoff diagram. This is a profit diagram. So what about profit? Can I write profit as S minus something? But what will be that something again? Because see, to get the profit, you are subtracting the premium from the payoff. So can I say that the profit will be nothing but this payoff minus premium? Agreed or not? Is this correct? Correct, Vedant. So it will be S minus 64. So we are just subtracting the premium from the payoff, which gives us the profit. So this part of the line is represented by P is equal to S minus 64. Okay. Now, a very interesting follow-up. Of course, it's very simple, but just the language of mathematics we'll use to make it more clear because it is very, very important that you understand this in the form of equation as well, in the form of simple equations. Like this is a very simple equation. P is equal to S minus 64. And if you compare it with y is equal to mx plus c, you will clearly see m is equal to 1. Okay, slope is equal to 1 because x-axis is s. So this is s, this is y. So y is equal to mx plus c. So m is 1. So slope is 1. What about this part of the line? Can anyone answer? What is the equation of the horizontal part of the line? Quickly.
y equals to -4.
Very good answer. Correct, Vedant. Yeah, you also, everyone is correct in fact. Yes, correct. So the equation of this part is equal to, is given by P is equal to -4. Of course, P is Y, so that's completely okay. Okay. So this is the overall equation. Okay, now let me just do one thing. Let me erase everything. So to generalize, okay, the equations, basically, we can write this as payoff minus premium. This is the payoff, this is the premium. Okay. Of course, we substitute 60 for K, and we know that if S is greater than 60, then P is equal to S minus 60 minus 4, and which will mean P is equal to S minus 64, whereas if S is less than equal to 60, then P is equal to -4. Okay, so everything is crystal clear over here. Now, the same thing if we replicate to the short call, we have this kind of a diagram and we'll have negative of the payoff of the long position. Okay, and to get profit also, we'll get negative of the profit of the long position. Okay, the difference is that in the short case, the graph gets pulled up, whereas in the long case, the graph gets pulled down. So, can you tell me the reason behind it? Very simple, we have discussed it many times. What is the reason?
We earn
Short.
the premium.
Exactly. Short is getting the premium. They're earning the premium. So, what is the y coordinate of this point?
0,5.
Y coordinate only.
Y
4.
coordinate.
And why 5? 4. The premium was
4.
4, guys. Okay. So it's 4. Okay. Z- The coordinate is 0, comma 4, but the y coordinate is simply 4. Okay. So if you just open the brackets and just try to remove this negative sign, you'll get something like this. Okay. And in fact, even a better way to write this rather than this, we should actually try and write this negative max s minus k comma 0 minus plus C naught. This will be better. Why? Because it tells you very clearly that this is the payoff. Okay. And this is the premium. Premium is being added to the payoff. Okay. So it makes more sense actually. Payoff plus premium in this case. Whatever is the payoff plus premium. Okay. Great. Next, for the long put, of course, for the long, again, it is the long position. So again, for the long position, since long is paying the premium, the graph will move down. It will be pulled down. Okay. So everything remains the same, the analysis. And for short put, the graph gets pulled up. Okay. So as I said, we are continuing this chapter from introduction to derivatives. So we are actually carrying forward all the discussions that we had in introduction to derivatives. Now, exchange traded options on stock. We have the
Sir, I have a
CBOE.
doubt.
Yes, please go ahead.
Uh, if we don't exercise the option, the
Mhm.
premium goes to the seller, right?
Correct. The premium
Yeah,
goes to
but
the option.
suppose if we exercise the option,
Mhm.
so in that case, what does happen to the premium? We lose the premium, right? In any
See,
way.
yes, whether you exercise or whether you don't exercise, the premium you have to pay upfront
Hmm.
in any case. So that is gone. In any case, the premium is gone. Now, the amount of gain or loss will happen will be determined by how much your option is in the money. Okay, so what I'm saying, if suppose we talk about a long put position, let's take an example of long put position and let's just assume that the premium in this case was 6. Okay, so let's assume. Let me check where does it map to. I think it's 5, right? So 5, yeah. Let's say the premium in this case is 5. Okay, the strike price is 60 for the long position. Now, if you exercise the option, the only case where will you exercise the option is when you are in this region when S is less than K.
Price is
Yeah,
greater.
yes. Strike price is greater, or you can say stock price is smaller than strike price. Now you see this region, okay, this particular region up to 55 actually. You are still not going break even, right? If even, of course, you will exercise as soon as or when you get a chance to exercise and you see that S is less than K, you have the option to exercise. If it's a European option, then of course you have to exercise on the last day only. So if it's a European option, let's say, and the price is between 55 and 60, so you exercise the option, but you still end up with an overall loss. Why? Because the amount of premium that you had given is actually more than the amount of payoff you are getting. Clear?
Okay.
Because profit is equal to payoff minus premium. So think about it. This profit will only be positive. Okay, there is, I think, a driver issue with the pen. That's why the handwriting is a bit weird, a bit elongated horizontally. Anyways, only when payoff is greater than the premium, which is 5 in this case. Yes or no? I mean, simple
Yes.
equation, right? I mean, of course, if this is greater than this, payoff is greater than premium, only then you will have this number as positive, right? So payoff has to be greater than 5 to at least, to give a positive payoff. So it means for a break even, the payoff should be equal to 5 at least, right? So you think about it, if you exercise the option between 55 and 60, between the stock price being 55, sorry, the stock price being between 55 and 60, so obviously your payoff is less than 5. You can check it. Let's exercise it at this point, say 57. What is the payoff? At 57, what is the payoff? Only payoff, not profit. Payoff.
3,
3, exactly. But how much premium you paid?
5,
Exactly. So at 57, what is your profit?
2,
No, it is negative.
-2.
Correct. So even though you are exercising the option, even though it is in the money, but still your profit is negative because the premium was upfront. You have already lost it. Okay. That is why I
But
said,
still, I'll exercise it. No,
yeah, you will exercise it because if it's the last date, if it's a European option, of course you will try to reduce as much as
loss. Yeah.
your loss as much as possible, or you can say you will try to increase your profit as much as possible. But that's why I said when I was explaining this to your question, the first answer I gave that it will depend on how much your option is in the money. How much? So right now it is very less in the money. It is only 3 units in the money. But what if the stock price was 45? What will be the payoff in this case? Only payoff, tell me. Tell me what will be the payoff. Strike price is 60, stock price is 45. What is the payoff? You are exercising the option. Don't go into this. No, in fact, it's up to scale. Completely okay. No problem. Yeah. What is the payoff?
15,
15. Very good. So, what is the profit?
10.
10. Exactly. So, profit is equal to now payoff minus the premium, which is equal to 10. And that is what the profit is over. Very clearly, it is 10 in this case. Okay. So, in fact, the alignment and the nature of the diagram has been drawn perfectly in this case. So, is the idea clear?
Yes, sir.
Okay. I'll just see others have also raised some doubts. Let me check. Vedant has asked, is the American slash European nomenclature geography based like in USA or in Europe? Or is it just a way of differentiating types of option? I remembered this earlier. In fact, when I used to teach, I think in pre-COVID times, I used to give this explanation. In 2020 videos, I think you'll find the explanation. Uh, is it geography based? I think of course, as of now, you can consider that it is just a way of differentiating types of options. I was thinking about the origin actually. So, yes, as of now, you can think of it like it's a way of differentiating the types of options. Because see, in every country, even in India, we have American as well as European options. Okay. Okay. So, of course, depending upon which exchange and which instrument you're talking about. Okay. So, we have that. Then another doubt is okay. I think there is a story of Samuelson. Okay. Lucky is saying there's a story of Samuelson. A European mocked him, so he named a simpler one European. Okay, that's great. So please go through it, guys. Okay, just check on Google after Google or GPT after the class that what is the story. Okay, and it is quite interesting. Okay, so you can see the story behind this. I'm not very sure if it's okay, correct or not. So maybe it's correct. But anyways, as of now, it is just a way of differentiating the two categories of options. Okay?
Sir, one more question.
Yes.
So, sir, suppose we consider call option.
Mm-hmm.
in that the seller of the option gets premium, right?
Correct.
Okay. So when we say that if the option is maybe the stock price is greater than the strike price,
Mm-hmm.
so the buyer would earn profit. And
The buyer would
same,
earn payoff. It is not necessary profit because again, see, it is about the
got it,
zone.
got it, got it. Okay.
But it's same thing. Yeah.
Suppose he earns the payoff and it is profitable, like it is more
Got it.
than the
Over here,
premium.
let's see. Yeah, let's
Yeah.
say over here. Yeah.
He earns profit, and
Mhm.
the same amount of profit would be the loss for the seller, right?
The same amount of profit will be the exact loss for the seller.
Yeah.
Absolutely correct.
Okay.
Absolutely
So,
correct.
but uh, what I think is, isn't it symbolical? Just like the seller is having a loss, but actually he gets the premium in any way.
Yes, correct. But loss is going to be loss. Seller is going to face the loss because
It's
once the
symbolical, no?
no no
Means
no no no
in the
no no
sense
no.
that he doesn't have to pay it from his pocket, no?
He has
That
to
way I'm
pay it
saying.
from his pocket. If the option is in the money, let's say at S is equal to 70. Let's take this case. At S is equal to 70, your profit is equal to 70 minus 64, correct? Which is 6. Okay. So for the short call at S is equal to 70, you can see that the profit is equal to, as I said, payoff plus premium. So payoff itself is actually negative 10 for the short position, negative 10 plus premium. Even if you add the $4 premium, it will still be negative, negative 10 plus 6, which is equal to, sorry, negative 10 plus 4, which is equal to negative 6. So yes, he or she short position
So
has to pay this
this
from
actually
his or her pocket
uh,
only.
this is because of the change in the price of the stocks, right?
Stock, absolutely correct.
Yeah. uh, that is what I wanted. Suppose if I buy something for 100 rupees, and
Mm-hmm.
I have a contract with someone that I have to sell it for 100 rupees, and
Mm-hmm.
for that he pays me like a deposit like thing, maybe like a premium 5
Okay.
rupees.
Mm-hmm.
Okay.
Mm-hmm.
So on the date when I'm going to sell that product to him, I have
Mm-hmm.
to sell it at 100 rupees, but
Mm-hmm.
currently the market price is 120 rupees.
Mm-hmm.
Okay.
Correct.
So that is what I was asking. Suppose if I buy it at 90 rupees, I am
Mm-hmm.
signing an option, like
Mm-hmm.
I am getting into an option of 100 rupees, that I will give it to him at 100 rupees
Mm-hmm.
after some time, and for that he is paying me 5 rupees,
Mm-hmm.
like the premium. And
Mm-hmm.
when on the date when I'm going to sell that product to him, or maybe he
Mm-hmm.
is going to claim the option, so
Mm-hmm.
at that time the market price is
Mm-hmm.
uh,
120. Let's say
120.
120. Mm-hmm.
Okay. But
Mm-hmm.
don't you think that is symbolical, right? Anyway,
Now I'll tell you
I've
very interesting part.
I've
I tell
earned
you where
10
is the
rupees
flaw.
plus 5
Yes, yes,
rupees,
got
15
it, got
rupees.
it, got it. So you are thinking in terms of the lost opportunity, correct?
Yeah.
But exactly. But there's a flaw in this argument. The flaw is unlike a forward or a futures a case where we had the asset was already owned or being owned or the farmer was about to harvest his or her crop. This is a different case where if you have to sell because you have agreed to sell, let's say you are the short position and the long position, you have agreed to sell it for $100 to me, correct?
Hmm.
But the issue is that you don't have the underlying asset right now. So while selling it to me, you will have to purchase it from the market and then sell it to me. That is the whole idea. And that is why this loss is not only virtual or symbolic, but it's an actual loss because you will buy it from the market at 120 and you will sell it to me at 100. Is it clear now?
Okay, okay. So they
That
don't
is the
have
idea.
it well in
Exactly.
advance.
Very good perspective. Yes, very good, interesting question. Okay, because these doubts can come in anyone's mind that this loss can be only virtual or symbolic because it is like you did not make a profit of 20. You lost opportunity of getting a greater profit. But no, that is not the idea. The flaw in this argument was that the assumption was that we are already holding the asset, but no, we are not holding the asset. Yes, we sold it for 100. Okay, if we were holding the asset, then we can say it would be a virtual loss, because if we had sold in the market, we would have got 120. But the problem is that since we are not holding the underlying asset, first we have to buy it at the market price and then we have to sell it.
So, sir,
Okay,
why do people get into such risky
short
transaction, like
positions.
where the probability is 50-50?
See, if the probability is 50-50, then there is less chance that they will go into short position. Okay, of course, there are speculators who can do that also. Even for 50-50, they can go for it. Because if the chances are 50-50, the premium earned will also be very high. Okay, but again, it is about the perception. Everyone has a different perception about the market. Let's say we entered into an agreement. You are the short position, I'm the long position. And of course, I'm talking about a put option. I'm in a long put, you are in a short put. You don't believe that the market will go down.
Mm-hmm.
Okay, but I believe that the market will go down. So, of course, it is a difference of perception also. Okay, but if the market is let's say if both of them are using the same kind of analysis and both of them reach to a conclusion that it can be 50-50, still you may be wanting to speculate because of the higher percentage profit, and you are willing to take that risk. Okay, because of the higher premium. Okay, so it's completely about your risk taking capacity and risk taking willingness. Both things matter. Okay, and of course the perception. Now, Lucky is asking, but why people hedge their position in using options, Lucky? Using options? Are you talking about hedging using options or general hedging? Because hedging is a complete different chapter which has been covered in chapter number 8, right? Hedging using futures and forwards. So, even hedging using options is the same logic. They hedge to reduce their risk. There are three kinds of market participants. Okay, there are three kinds of market participants. You have hedgers, you have speculators, and what was the third one? What was the third one?
Arbitrager.
Arbitragers, correct. Okay, so you hedge your position because you don't want to take that risk. Okay, you want to reduce the uncertainty. Speculators actually take the risk. Okay, Lucky. Speculators, they take the risk. And arbitrageurs, of course, they try to exploit the mispricing in the market. So it's a very simple answer. And we have given a lot of examples in Introduction to Derivatives also, FMP 7 also, and FMP 8 also, that what can be the motivation to hedge and what can be the motivation not to hedge. Everything is covered. Okay. So, but the basic idea, just remember that as of now, we know that people hedge their position because they don't want to take on that risk of changing prices. Okay, so that is the idea. Because in this case, let's take an example. Let's take an example of a long call. Okay, so long call, what the long call is doing? Long call has bought this call option. So long call is also kind of hedged against the prices drop below 60, right? But still, there is a lot of scope of profit if the stock price goes above 64. So it's like an hedging, but options should not be generally considered as a hedging instrument. Generally, they should not, because generally we use futures and forwards only in most of the cases. In some cases, options are also used, and in fact, we have done the example of hedging using options also, where there was a U.S. Treasury, the the in charge of the U.S. Treasury, who used options also to hedge the position. In the same chapter we have done, hedging chapter only. Okay, now let's see this part. Yeah. So Chicago Board of Exchange is the largest uh, Chicago Board of Options Exchange, or Chicago Board of Exchange. I think it's the largest options exchange in the world and trades over a billion contracts each year. There, the options are American style. Okay, they can be exercised at any time before the maturities. Now over there, one option contract is corresponds to 100 shares. Now stock options, now this is very, very important. Maturity cycles. Stock options on the CBOE are assigned one of the following maturity cycles. You can have January, April, July, and October, which is referred to as the January cycle. You can have February, May, August, and November, which is referred to as the February cycle. You can have March, June, September, and December, which is referred to as the March cycle. Now, there are very, very important points that we'll discuss with respect to exercise of this kind of uh, the options where they follow different kind of cycle. So the important part which we have to understand, the important actually day I should say, the important day of the month that we need to first understand is that it is third Friday of every month. Now, third Friday of every month, whether the option is expiring before the third Friday or if the option is expiring after the third Friday, that makes a lot of difference to uh, the structure of the option. Okay, so if we are, and I'll give explain this using examples. Suppose you are having an option in the February cycle. Okay, let's say we are having the option in the February cycle, and let's say the current month is September. The current month is September. Okay, so don't get confused. This is the February cycle, the option, and the current month is September. Okay, now before the third Friday of a month, you will have options trading for the current month, for the next month, and next 2 months of the cycle. So these two are not of the cycle. This is just depending the current month and the next month depend on this current month where we are currently. So currently, let's assume we are in September. So before the third Friday, you will have the options trading for the current month, next month. Current month is what? September. Next month is what? After September comes October. And then the next 2 months of the cycle. Which means that after October in the February cycle, what are the next 2 months? Can you tell me?
Feb May.
Again, I'm repeating.
February. No,
After October in the February cycle, after October, what are the next two
November and February.
months? November is the, after October, you have November, right? And then February. Current month is September. So we'll take multiple examples over here to make everything crystal clear. Let's take multiple examples to make everything clear. So I'm repeating my point again because it is possible, as I said, it is possible. I mean, initially only I told that this is a bit tricky. Okay. So we'll take some time to understand it. I said that before the third Friday of any particular month, before the third Friday of any particular month, the options will trade for the current month, which is of course September in this case. They will trade for the next month, which is October. After September, you have October. And then once you are done and through with these first 2 months, then you will consider that after this next month or after October, what are the next 2 months in this cycle? So obviously after October, you have November in this cycle and then you have February in this cycle. Okay, so that's the idea. But when the third Friday is over, because this is when the options expire. The standard expirations of the options is set to third Friday of each month. So when we talk about, let's say, you have a set generally in the US, when you say that okay, this is a December option, it will actually end on the third Friday of December. So that's the convention. So on the third Friday of a particular month, okay, the September option is going to expire. So September option is gone now. So after that, you will have next month, month after that, and the next 2 months of the cycle. Okay, so it means that after the third Friday, you will have October, November, and then after November, what are the next 2 months in this cycle? February and May. Okay, so I'm repeating once again. Over here, we had September, October, November, and February. And in this case, we are having October, November, February, and May. Okay, so we'll take two or three more examples to give more clarity on this. So first tell me, is this clear? And then we'll take a few more examples in this slide only. To everyone, because see, this might sound a bit technical and tricky, but actually it's very, very simple. The only thing is that you have to remember these cycles from the point of view of the exam. They may or may not give you. In fact, we have seen in some cases where they even give all these 4 months, February cycle, which 4 months. But you have to be prepared that they will not give this information and you have to learn these 4 months. It's very easy, right? So the January cycle is Jan, April, July, October. Okay. And then you have February, May, August, November. Then you have March, June, September, and December.
So there
Right?
is a gap of 2 months between each month.
Exactly. I was about to say 3 months actually. But yeah. So actually, if you see January to April, it's
Feb, March.
actually 3 months. Okay. So after every 3 months, then April to July again 3 months. Then July to October again 3 months. So three months basically.
Sir,
That's
can
that.
I ask a doubt?
Yes, you can also say plus 2 months, but the gap is actually of 3 months, right? First January, first of April. If you see, there are total 3 months. First January, February, March. Yeah, please go ahead, Parth.
So inclusive of January, it is three.
Inclusive. Yes, because see, you're not starting on the 31st of January now. You have to include January. Why? Because we are talking about the whole January, correct?
Yep.
So absolutely right. Inclusive of January, it is 3 months, correct? Yes, please go ahead.
Sir, the doubt is I understood these cycles, like
Mhm.
how they work. But
Mhm.
when you say that option matures before the third Friday and it can be, I'm not understanding that concept.
The
What
last
is this?
date, the maturity date of the option is third Friday. For example, as I said, let's say the current month is September, say
Yeah.
2025.
Uh,
Let's assign a date also to it. Now, can you just check the calendar right now and tell me what is the third Friday of September 2025?
just 19 September.
19 September. So the idea is that the
It will
September
expire.
option will expire on 19 September. That's
Okay.
it. That's the idea. Okay.
So what is this next month and other months of cycle?
Next month and other months of cycle are referred from this.
Yeah, yeah, I got it.
Okay.
Suppose if an option is expiring on the third Friday of
Yeah.
September,
Yeah. So this
then
September option expires on 19 September.
yeah.
See, because uh, in that particular month, obviously the option for that month only will expire, right? So on the third
Mm,
Friday, that is on 19th of September, the
mm,
September option expires. So obviously
okay,
you'll have to add one more option because generally the idea is the exchange wants to keep four options floating at a time. Okay, Parth. So
okay.
they want to float four options
For whom?
completely for the market participants who
Okay.
want to
So
buy
it
and
is,
sell.
it is compulsory for all participants to have four options.
No, 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 no. It wants to float. Those who want to buy it, they will buy it. Like, you remember we saw the MCX website for futures. Remember that?
So they want to have options for options.
I'll just explain. Do you remember the MCX website that we had? we had seen for crude oil futures.
Yeah.
So you remember at a time, three contracts were only trading.
Yeah. Yeah. Yeah.
So the same thing. At a time, they want four contracts to be traded.
Okay.
Okay,
Okay. Got it.
got it. So that is the
So
idea.
before the third Friday,
Mhm.
there is one option which is
For the
going to
current
expire
month.
on third Friday of September.
Correct,
There is
correct,
one
correct,
option that is available for trade. That there is one option which is going to expire on October third Friday. There is one
correct.
option which is going to expire in November third Friday of
Absolutely correct.
November, and
Correct.
one more
Absolutely correct.
last one.
Correct.
So for transaction, these options are available in the
These
market.
options are available. Absolutely. So
Okay, okay,
every month, third Friday, some options will expire. So as one option expires, they have to make another option available.
okay, okay, okay.
Okay,
Got it,
so
got
that
it.
is the idea. Okay, yeah. Now Vedant is asking, what is the need for creating this convention? See, what was the origin that I cannot tell you, but the need, I think the requirement should be quite clear. Again, to maintain liquidity in the market, Vedant, it is better to have, because see, if suppose the option is expiring, say, on the third Friday, and we don't have another option, of course, people who want to go for long dated options, although there will be less liquidity in that, but still, at least there will be some liquidity. So, yeah, it is better to have one option. Now, I think your question can be why third Friday? What kind of convention is this? Why not we had the last date of the month to make things easier, right? And why not, why to create even cycles? Why not just have the next 4 months, right? That also we can think of, right? Let's say we are currently in August. If we are in August, why take so much of hassle? Why not let the options having the expiration date as the last date of a month, and then maybe for the next 4 months we can have one option each, right? That would have been simpler. But again, there are reasons behind the origin. Maybe there was something with respect to liquidity, something with respect to salaries, because earlier when exchanges were originating, there were times where things were also related to how much money is there in the market right now. So maybe they believe that the third Friday, after third Friday, things will be a bit loose. Maybe because of that, let's introduce the least liquid option after the third Friday. Because people who are salaried, people who earn wages, they actually earn most of their wages on the first of a particular month, and by the third Friday, they have less money. So let's float the least liquid options after that. Maybe because the trading activity was less. Just one of the logics which came to my mind. I am giving you. It may not be correct. It may or may not be correct. Okay. So just an idea. That's why, right? It's the history also matters. Context also matters, right? Okay. So yeah. Yes. Absolutely,
Hello,
Shiva.
sir. Uh,
Shiva, the
uh,
question is not that. Shiva, the question is that, see, even a simpler case would have given the opportunity, right? That is what Vedant is asking. So let's say if it expires today, and rather than having, say, one option, we could also have, say, options in a gap of 2 months. Say, if we are in August currently, then maybe we had a October option, then December option, then February option, then April option. Even in that case, it gives the opportunity for investors to trade for short term as well as buy long term, even in that case. But yeah, one thing I can note, Shiva, that yes, in this case, it gives the opportunity for the investor to trade in ultra short term also, right? Ultra short term because you have the next month also, and then you have some longer term also. So I think your point is fair in that regard. Okay, completely fair. Yes, please go ahead.
uh, sir,
Yes, Lucky, please go ahead.
two things like in this cycle concept, I need to
Hmm.
know the maximum, the longest option we could have is 9 months
The
for
longest option that we can have, yes,
the,
if you are currently, say, in September after third Friday, then you can calculate, yeah. So there'll be 3 months over here. Actually, we are getting 8 months.
yeah, in 8 months in hand. Okay,
Yes, yes.
and different
Eight
things,
after
sir.
third Friday, and
No,
before third Friday, in fact, we have much less. If you see, we are having September, October, November, and February only. Correct. Yeah.
and
Go ahead.
sir, another thing is that how could we know like the given date is third Friday before third Friday or not? like calendar dating, the day date, I think.
No, actually, that
Is it
dates will be
possible?
given. See, when we talk about third Friday is a convention, but whenever any kind of question is given, or even in the market, they will not actually say that the option is expiring on third. Third Friday has already been decided, so you will already know that this is the date based on the third Friday.
Sir, that's not the thing. Like, yeah, so in the question we are given, say for a date like it's 21st of September. So
Mhm.
there is a higher probability that that it could be a Friday.
But
So
it will be given in the question. It will be given in the question.
in the questions, in MF questions and GAP questions which are provided, these things are not given. Like, is it before third Friday or not?
No, then I think there will be some other context where there will be a hint directly related to the dates. If it is not there, please let us know. Okay, we'll let you know how to figure it out. If that is the case, I think there should be some kind of hint with respect to your days as well as the dates where you are currently after the third Friday. Okay, and what are the options which can be available based on that cycle you have to determine. So let's say if the exact date is also not given, let's say if it's given only what you're saying in the MF questions, it is not given, you are before or after third Friday, correct?
Like the date is given, so how
Date
could
is
we know
given.
like it's before third or after third? That's the thing now.
Okay, okay, that is the point. Okay, okay. I think then then you can of course look at the calendar. I think they give the option to check the calendar in the exam
Sir, in
also.
exam also.
Yes, yes. In the exam also they give you the option. If suppose this is the case where they give the date and you have to figure it out whether it's the third Friday or not, then they will probably give you the calendar.
Sir,
But let's say in the worst case, if nothing is available to you, only the date is given, which tentatively you think it's a Friday, then of course, since the option is expiring on that particular day, you have to assume that it's the third Friday.
okay.
Okay.
So
But
what
please
will be
let
the
us.
convention, sir? What would be the
Yeah, that
convention for us?
convention will be that the option expiration date has to be treated as the third Friday unless and until given in the question. Okay, Lucky?
Okay.
That has to be the
Sir,
convention.
by the way, will it be possible for you that you confirm that are we gonna get calendars or not?
Oh,
Are
yes,
we
I
allowed?
can confirm this. And in fact, I'm almost sure that you'll get the calendar because uh, I don't think see the softwares they install. I think don't think the operating system is changed, right? Anyone who has the idea, who has an experience of taking the exam once, they can enlighten. I don't think the operating system changes. Okay, they will provide that, and the calendar will be provided if required. But yeah, that will be in the worst case. I don't think. I mean, based on the question, you'll not be able to figure out. I think that will not be required. Don't worry. You can assume safely that if the option expiration date is given, it will be the third Friday. Okay, don't worry about that. And
Okay.
if it is not there, again, I'm saying the calendar will be provided for sure.
And sir, also, what is significance of this cycle? Like, if we consider an example, will it be possible to
Yes.
demonstrate through an example, sir?
Yes, yes, I'll
Will it
explain
be
the significance. Again, we discussed that significance is basically providing the traders and investors with short-term as well as long-term options, injecting more liquidity in the market. Okay, as much
Mhm.
as possible. That is the whole idea. And we'll take another example to make it more clear. Two more examples. Let's discuss two more examples. Okay, Lucky.
Okay, sir.
Yeah,
Okay.
so Shiva has also answered your point, Lucky. Shiva is saying that the question will have current date, expiration date mentioned, cycle and months only has to be calculated, and calendar will not be required according to Shiva. Okay. So basically, okay, now Vedant is asking current month options, next month options would be till the third Friday of the current next month only. Yes, Vedant, correct, correct, correct. Absolutely correct. Okay, let's take another example. Let's say we are in the, I'm marking here only. Let's say we are in the March cycle now. Okay. And the current month is August 2025. Current month is August. So example 2. This is example 1. So we are in the March cycle. This is the option is in the March cycle. Currently, we are in August. So tell me before the third Friday of August, and try and give answers via private chat if possible. Okay, otherwise public chat is also okay. So currently we are in August. Option is in the March cycle. Before the third Friday of August, what are the options which are available? Okay. Okay. So some of you have answered incorrectly. In fact, most of you have answered incorrectly based on the private chats also now. But there are some incorrect answers as well. Okay, so actually it will be the current month. So August will be there for sure. Then the next month. After August, you have September. So for the first two, you don't even have to look at the cycle. So these two are independent of the cycle. Remember that. These two are independent of the cycle, just like these two. These two are also independent of the cycle. But then you have to consider the cycles. Okay. So in the March cycle, which month is coming after September? Which next 2 months are there? Of course, you have December and then you have March. So the answer will be August, September, December, and March. What about after the third Friday? What about after the third Friday? So next month, September. Okay. Then the next month after that, October. Okay. And then after October, which are the next 2 months in the cycle? Again, you have December and March. Okay. So in a way, if you see the newest option which is available, because if you see these three options are same. In this case, one new option is being made available, which is the October one. Okay, so something basically it's not necessary that only longer dated options will be introduced after third Friday. Sometimes it is also possible based on the cycle that mid-term, short-term options are also introduced. Okay, so this is the idea. Is it clear now to everyone? Okay. Now Vedant says this convention also brings uniformity in the availability of in the demand uniformity in the availability and demand of the option. Yes, I think I'll not say demand, but yet, because uniformity in demand we don't know actually Vedant, but yes, uniformity in availability, yes, definitely yes, without any doubt. Okay, demand we should not say. Yeah. Okay, now let's move on to the next part. The CBOE also offers short-term options called weeklies and long-term options known as leaps. So weeklies mature on Friday, other than third Friday of the month, and are typically offered on several such Fridays. Leaps, this is basically theoretical, you can go through it yourself. Strike prices part, you discover this from the PDF. Index options, so basically the theoretical parts we are not covering. ETP, non-standard trading, okay. Now, margin requirements. This is again very tricky, very, very tricky. And again, just focus on the mathematical part, just the calculations. You will be very, very clear on how to solve the questions in the exam. So, options with maturities of less than 9 months cannot be bought on margin and the full price must be paid upfront. And options with maturities greater than 9 months can be bought on margin, but no more than 25% of the purchase price can be borrowed. Now, if a trader pays cash for an option, there would be no margin requirements because the trader has no future liabilities. However, the seller of an option does have potential future liabilities. Now, think about it. If I'm the option buyer or the holder, I want to go long in the option. I pay the entire premium upfront. Can I have any potential future liabilities? Let's just recall the diagram once again of the short. In fact, let's first discuss the long, then we'll discuss the short. Because if I have the long position, I will not have any liabilities, right? I have already paid the premium upfront. Now, either I will get the profit or I'll not get the profit, but I'll not suffer more loss. Agreed or not? Correct. Absolutely. Yes. So long position is not going to have any liabilities or obligations in the future. But short position can have liabilities because if the long chooses to exercise, then the short will be can be in a negative profit zone, and that profit potential, that loss potential, I should say, particularly in the case of short call, theoretically that loss potential was unlimited. So let's just recollect the diagram, this diagram. See, the short will continue to have more and more obligations as the stock price is increasing, right? This is for a short call. Okay. The long call, of course, will not have any obligations. The long call, in fact, will have profits. So in the beginning, the long has already paid the premium. Okay. So this is for the long. And this is for the short call. So short call gets the premium if the stock price stays low, no problem at all. But as the stock price increases, the long position will choose to exercise and the short position will have more and more obligation if the stock price increases more. Okay. Actually, like it's initial margin, like yeah, it's initial margin. Okay. So that is why long positions don't have any initial margin requirements. Only short positions have the initial margin requirements. Long positions are happy, they just pay their premium. Okay. So, how it is calculated? The requirements for a short call position include 100% of the sales proceeds. So, even if the premium is paid, sales proceeds are basically the premium. Okay. The amount of money that can be obtained after selling the option, that is the option premium. Okay, along with the greater of the following two values. So even after that, I mean after collecting the option premium, the exchange is still not happy with only the option premium. The exchange wants more guarantees, more collateral, you can say. Okay, because they fear that what if the short position fails to honor his or her obligations, what will happen then? Okay. So in that case, after the option premium also, they will take something extra. So they will take the greater of these two values extra along with the option premium. So either it will be 20% of the share price less the amount by which option is out of the money or 10% of the share price. So whichever is greater, they will take that along with the option premium. So of course, the best way to understand this is using an example. The best way to understand the calculations are by using an example. So let's take some example. And yeah, for a short put, it is like this. Short put is basically along with the premium greater of these two. So let's take an example, as I said. So let's say you have call option with a price of $4 per unit of underlying. Call option price means call option premium. Okay, this is what you are buying it for. Say S is equal to 40 and strike price is equal to 41 currently. Okay. Now, first let's calculate these two. 20% of the share price less the amount by which the option is out of the money. 20% of the share price less the amount by which the option is out of the money. First calculate this because we have to calculate greater of these two. So 20% of the share price, which means 20% of 40, 20% of the share price minus this part. This part is nothing but the amount by which option is out of the money, because you can see that in this case it's a call option, it's out of the money, it's very clear. Okay, if you exercise this it will be a negative payoff, so it's out of the money. By how much it is amount of the out of the money, that's actually kind of a safety margin, because the more the option is out of the money, the better it is for the short position, right? So that is why we subtract this amount, because this amount has to be given to the exchange. So we don't want the short position, of course, will not want more and more money to be given to the exchange. Okay, so this is a safety cushion for the short position, because this is the amount by which the option is out of the money. So the option is out of the money by $1. Okay, if the stock price moves up by $1, it will be at the money, and after that it will be in the money. So you can just see this part. Suppose this is S is equal to 40. So if S is less than 41, which is the strike price, so this zone is out of the money. So right now the option is out of the money. If S is equal to K, then it will become at the money. And in this case, it will become in the money. Okay, so this is $7. Now let's calculate the second part, 10% of the share price, right? That was the second part, 10% of the share price. So 10% of simply the share price, which is how much? 10% of the share price is how much? 4. So what is the greater of 7 and 4? What is the greater value between 7 and 4? I mean, it's of course it's obvious. Come on, please. Which one? Obviously 7. Okay. So what will be the margin requirement for the option? Can you tell me? What will be the margin requirement for the option? Vedant, I'll come to your question after some time. What will be the margin requirement for the option? Margin requirement. So we discussed sales proceeds plus greater of this two. Very good. Correct, Ujjwal. Sales proceeds means option premium. So option premium plus greater of these two, which is $11. So obviously, if one option contract is 100 shares, then net margin requirement is $1,100. Okay, so please let me know which step. If suppose it is not clear, let me know which step is not clear. I'll just explain everything once again, and I'm just going to a question right now. Vedant has asked, can margin submissions be in the form of non-cash like collateral? Are there any restrictions on valid margin entities so that risk diminishing of value is covered? I think Vedant, yes. I think even in options, margin submissions can be in the form of non-cash like collateral. They can be all treasury bills, treasury money market instruments like bills. Okay, or I think other highly liquid instruments. Of course, there will be restrictions, but I think it is possible, yes. And are there any restrictions? But I think it will be better that you give it a check once again, okay, after the class. Because I think it should be valid. Because more in many of the contracts, especially when we talk about over-the-counter contracts between two parties, even complicated contracts, they are allowed. The non-cash collateral, highly liquid securities are allowed. Okay, even exchanges should allow that, I think. And are there any restrictions on valid margin entities? Are there any restriction on valid margin entities so that risk diminishing of value is covered? Okay. Yes, I think, see, when we talk about collateral, there is always a haircut, right? So that the risk diminishing of value is actually covered. So there is a haircut sometimes. And yes, there are restrictions also. That is why only highly liquid instruments like treasury bills should be allowed or are allowed for collateral, which probably won't diminish in value within a short period of time. But yes, there are restrictions. Definitely, yes. Okay, next question is margins are just deposits. I mean, they are returned back to the depositor after the option is yes. Once the contract is settled completely, the holder, or sorry, the depositor who gave the margin, yes, they can technically they can take that balance out of the margin account, and if required they can initiate another trade also. But yeah, ideally they can take it out. Yes, definitely, it's just like a deposit. Absolutely correct. Okay, that is only used in case the value of the short position is going down more and more negative, then the margin will be utilized. That's the idea. Very good questions. Okay, so is
Sir,
it clear to everyone? Yes, please go ahead.
so sir, uh, can you go to the previous slide?
Yes. Yes.
So they have mentioned like the two requirements, like 20% of the share price less the amount the option is out of the money.
Mhm.
So whether it is out of the money, in the money, we will get it to know only on the date of maturity, right?
Only under the no, no, no. At the current point in time, if it is out of the money, no, it is moneyness can always be inferred, no problem at all, because K is known, right? K is fixed path,
Yeah.
S is the current stock price. So
Yeah.
currently, based on the current stock price, whether the option is out of the money or not, that is the idea.
Hmm. But who decides that date?
Who decides the
Date.
expiration date or current date?
No, no. Suppose the long position
Mhm.
uh, got into long call, got into an option on say 1st of April, and the
Got it.
expiry is on 30th of April.
Got it.
So for the entire duration of that month, the stock price can be anything. No,
Correct. It
either
can
it
be
can
in the
be
money.
lesser than
It can
strike or greater
correct.
than strike. So
Correct.
on
Correct.
which particular date should we consider that
Every single date, whenever you enter into the trade, in fact, okay, you are asking about the calculation is based on which date, right?
yeah,
Out of the month. Okay, so it is based on that date when you have entered into the contract, that particular
1st of
date.
April.
Exactly, 1st of April for the short position. Because see, the long is already done with the premium.
Yeah.
The corresponding short position, yeah, for the first April only, it will be considered as the date to decide the moneyness of the option. Absolutely correct.
Okay. And
Okay.
sir, one
And
more
I
thing.
think Parth,
Yeah.
this since this question you have raised, I think it's very interesting to see what if uh, the stock price moves and the moneyness changes, will the margin requirement decrease or increase? That is also a very good question. Actually, if you see, let's follow up on your question, because on 1st of April we decided, right, Parth? But
Yes.
what will happen if suddenly from out of the money, the stock, this position becomes in the money? Will the margin requirements of the short position increase? I think it should. I think it should. Yes.
You mean the
Exactly,
deposit?
Vedant. That is what I was saying. Yes, yes. I think it should. Again, do some
But so,
research
sir,
on it.
in that case, suppose if the long, I mean the holder of the option wishes to exercise it.
Uh-huh.
So in that case, I'll get the deposit back, right?
Yes, of course. Apart from, see, if you're ordering your commitments from the deposit, only that amount that has to be given to the long position, that will be deducted and the deposit will be given to you. Because, see, in any case, you have to pay to the long position depending upon how much the option is in the money, right? So let's say the option is in the money by 10 units, okay, $10. And your deposit was, uh, total deposit was $11. The option is in the money by $10. So of course there's a premium also. So
Mm.
if the option is in the money by $10 when the long chooses to exercise, you will get the premium back. Of course, premium
Yeah,
was given by the long to you
yeah,
to collect the
yeah.
to get the option. So four is being given, of course, but then there will be deduction also because the option is in the money by
Mm.
10 units.
Mm.
Okay. So it means that how much the long will gain. The long's profit also has to
And
be taken care of. No, the payoff is 10 actually. The option is in the money by 10. It means the payoff is 10. So the profit to the long is how much? 6 actually.
6.
Yes.
Yeah.
So actually you will be given 11 minus 6, which is 5. This will be returned to you. Got it? That's the idea. So I think yes, margin requirements, they should be, even though it's initial margin, okay.
So, sir,
This,
what if on 1st of April the condition was in the money?
if it is in the money you're saying, then of
Yeah.
course more margin will be required because let's say
Okay.
if it is in the money, then instead of S being 40, it can be 42, right?
Yeah.
So this will become 42, okay,
Mm.
and this will become negative 1. So you'll have plus 1 over here. In fact, instead of minus 1, which means
So
this will become
$9.
9. Correct, absolutely. Okay.
9 plus 4, 13.
13,
So I have to
absolutely.
deposit 13.
Yes, 13 will be the initial margin, and
Huh.
every day based on the stock price, this margin will be refreshed absolutely every day. It should happen, right?
No,
Ideally, it
the
should happen.
margin
And
will be refreshed, but even I have to refresh the deposits. Like I have to change
yes,
the
yes,
deposits every day.
exactly. Margin being refreshed means the short position has to completely replenish it. If the margin call comes, okay, that your margin requirement has increased and you originally deposited $11, the exchange can
$13.
once again, yes, 13 in the case of in the money, right? But
Uh,
yeah, 11 in the case of 40. So let's say you've
mm,
deposited, let's say this is the initial case, okay, Vedant, S is equal to 40, and next day it becomes 42.
mm.
You have to deposit $2 more,
Okay.
okay? You have to make it from
So
11
this
to
will
13.
continue until either the option matures or uh, the holder exercises the option.
Correct. Absolutely correct. Okay. Now, I think there we have gotten some inputs also from some candidates regarding this. Vedant has asked first a question: the CBOE provides interest earnings? Exactly. So this was my point, and yes, Ujjwal. Ujjwal has already answered it. Yes, actually, even in futures, the extra margin which is deposited. If suppose you decide to give the margin, and in futures whatever margin is being deposited, for especially extra margin, you earn interest on that amount. But in this case, in options, it's not only about the extra margin. I think since you are actually depositing a higher amount, not only your option premium, but also something for security. So you are actually uh, giving a higher amount over here. So I think the interest should definitely be given on the total amount, not only the extra amount. Am I correct, Ujjwal? Based on span, yes. Perfect. So it's on the total amount. So yes, we get the interest as short position holders, we get the interest from the exchange. And that is based on the span file published by the CCPs. Great.
Sir,
Okay. Yes.
so
Please.
suppose on the first day, 1st of April, the margin requirement was $13, and on the next day, suppose it has gone down to $11. So in that case, does the exchange, right, where we
Mhm.
deposit the
Mhm.
money,
You
will
have the
they
right to
return the
get it
$2?
back. You have the right to get that $2
Okay.
back, or you can keep it deposited. You can earn interest on that. Correct,
Okay.
Ujjwal? Am I right? Is it correct? Those who have an experience that $2, if okay, usually saying span is for margin calls, interest would be passed on to clients by CCPs plus minus few basis points by the broker. Yeah, got it. But let's say if the margin requirements decrease with time, so I'm saying that there are two options. Either we can withdraw that extra margin which we had deposited, or else we can keep that extra margin, and even on the total margin, we'll still earn interest. Is that correct? Yes. Yes, Parth, that's correct. Okay. So yeah, so this is daily calculation. Okay, so it's not basically, see what happens is it's not that we are going to earn interest only on the margin which is required only. But okay, that was my question, Ujjwal, that even if something extra is there apart from the initial margin which is required, even then we are going to earn interest on that total amount, Ujjwal. Correct? Whatever anything you have pledged, absolutely great. So anything which we have pledged, even if it is greater than the required amount of collateral or required amount of margin, then yes, we are going to earn interest in cash. Great. Fine. So
Sir, can
this
you go to the previous slide?
yes, 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 absolutely, please. Yes.
Okay, so the first point is maturity is less than 9 months.
Mm-hmm.
Bottom margin, full price must be paid upfront. Full
Mm-hmm.
price, yeah, meaning the entire margin.
The if options with maturities less than 9 months cannot be bought on margin, and the full price, yes, actually, if suppose you have, I mean, now this is the first 2 points are purely from the perspective of the long position. So if suppose the option is having a maturity of less than 9 months, then the full option premium must be paid, because for the long position there is no margin.
Okay,
Okay, we are
only
talking about
premium.
buying the option. Yes, only the premium. So full premium has to be paid. But
Okay,
if suppose option is having greater than 9 months of maturity, then you can still buy them by not paying the full price, but some percentage of the price, some margin which is required. And that margin is based on the fact that you cannot borrow 25% of the purchase price, which means that effectively you
I
have to
can buy
pay at least,
75%.
yes, exactly, at least 75% of the premium you have to pay.
Okay, got it.
Got it? That's
Thank
the
you.
idea.
Thank you.
Okay. Yeah. Next question. Vedant is asking if margin account balance is less than the required margin, the exchange would not allow the, if margin account balance is less than the required margin, the exchange would not allow the short position holder to execute the trade at all, or would allow with some penalty interest charge. Now, I think ideally, I think again, Ujjwal can also enlighten us in this, but I think ideally what should happen, that the short position holder, I think it is possible that the position might be offset immediately if the short position is not giving more margin, okay, or for replenishing the margin account balance, and whatever deficit is there, it will be covered from the short position's initial deposit, initial margin, and then the trade will be closed at that point only. Okay, if the exchange is not satisfied that the short position is going to honor the margin obligations in the next maybe couple of hours or couple of days, depending upon the severity of the trade, depending upon the severity of the loss, volatility of the market, all these factors come into picture, and also the relationship of the the option holder or the short position with the exchange. Okay, or with the broker. So I think these things matter. Ujjwal, can you just enlighten us in this also? Okay, Ujjwal is saying debit interest is charged, but as per the CFTC rules, by day 5, the account should be brought back to cover. If not, then trade restrictions will be imposed. Okay, but but will they not offset the position after waiting for 5 days, Ujjwal? Is it possible that they wait for 5 days and the short position? Yes, correct. So that is the idea, that see there are two aspects now that Vedant we have learned regarding this. The first aspect is that debit interest will also be charged. Okay, so the amount of, because the on excess amount, since we are earning the entire interest on the amounts, so obviously if the amount is less, then debit interest will be charged. But as per the CFTC regulations, by day 5, if the account balance is not brought back to the cover, then the trade restrictions will be imposed, and if required, the position will be offsetted. Okay, so that is the idea. And there is the margin handbook, Ujjwal is saying, by JAC, which is available online. It clearly provides the guidelines. Okay, so please go through that. Thank you so much for your insights. So Vedant is saying, okay, so 5 days is the maximum interest, maximum that can be charged post that position would be off. 5 days is the maximum where interest can be charged. Post that, the position can be offset if required, Vedant. Yes. Trade restrictions will be placed immediate. Exactly. Yes. See, I mentioned that client relationship is also very important. And I think, Ujjwal, volatility is also very important. And severity of that position is also important. Because even if the client relationship is great, okay, but if suppose the position is so severe and volatile, I mean the exchange, the broker is seeing that this is bound to make massive losses, then of course the risk department will take a call that you have to offset the position. Absolutely, yes. Or maybe if it is stable, it is not very you can say volatile, then maybe the risk department will take a call that okay, we can wait for some more time, but still the trade restrictions will be there. After 5 days, trade restrictions will be there. Okay, fine. Great insights. Great insights. Thank you. Okay. So now let's say if we are talking about indices, then actually the 20% in the previous calculation is replaced by 15%. That's it. Everything else remains the same. Now, while options on individual stocks trade primarily on exchanges, options on foreign currencies, interest rates, and many other financial variables are traded actively in the OTC market. The main advantage of OTC market is that financial institutions can tailor what happened to the pen? Yeah, they can tailor options to meet the specific needs of their clients. And the size of the typical options transactions in the OTC market is definitely larger, of course, and the options often last longer than those traded on the exchanges. OTC options can also be exotic options. Okay, this you can cover from the PDFs, and PDFs. Sorry. Okay, so that's it for this lecture. Anything else from this particular chapter only? We had a really interesting session, excellent questions asked, and excellent insights given. So can if there's any question from this chapter only, please go ahead. Otherwise, we'll end this lecture. Done. Okay. Thank you very much. We just end the session. Thank you.
Sir,
Yes, yes, please, Parth.
sir, the effect of dividends and stock splits.
Mhm.
There was a line that they have written that options are not adjusted for cash dividends.
Okay.
So
Options
what does
are.
that mean? Like dividends are not paid in the form of cash.
I'll just write that. Okay, somewhere. Yeah, please go ahead. Options are
Not adjusted for cash dividends.
not adjusted for cash dividends. Okay. So ideally, I mean, theoretically, we saw that dividends, since again, theoretically, since dividends reduce the price of the stock, so they should have an inverse relationship with call and a direct relationship with put, right? That is what we saw earlier. But over here, it is written, where it is written in which section? Can you tell me? Is it in
Schwezer,
the
Schwezer.
Schwezer? Which section of Schwezer? Which
The
section in this chapter?
effect of dividends and stock splits.
Effect of dividends and stock splits. Okay, after this line, what is written? Can you tell me, please? Can you read out, please?
Yeah. In general, options are not adjusted for cash dividends. This
Mhm.
will have option pricing consequences that will need to be incorporated into a valuation model.
Okay. So as we saw that theoretically, uh, the stock prices should change. Okay, and based on that, we should have theoretically a direct or in fact properties of options we are going to do today only after this chapter. So today we'll see at that theoretically the stock prices should decrease once you pay the dividends, once the company pays the dividends. And because of that, the call option prices and the put option prices, they will also change. But if we incorporate these minor changes in the option price, then of course it will become a bit difficult to value the options and the model will become more complex, the option valuation model. That's why what we do not adjust the options for cash dividend so that the model of valuation becomes, does not become very complex. That is the statement.
So
Okay.
they do it in the form of stock dividends.
In the form of stock dividends, yes, I think for the stock dividends they will adjust it because I think that
Okay, sir.
adjustment
In
is quite
huh.
straightforward. Yeah.
In
Yes.
stock split, we know if it is for 2 for 1, like the
Mhm.
stock is split into two. So
Mhm.
number of stock increases to two, and the
Mhm.
price would be divided by
Half.
two.
Correct. Correct.
Yeah, yeah.
So
Okay.
same. So
So
yeah.
here there is a line in Schweitzer that, for example, in with respect to stock dividends, I'm asking. The idea of stock splits is clear, but
Mm-hmm.
this line is not clear for stock dividends. For
Mm-hmm.
example, if a stock pays a 25% stock dividend,
Mm-hmm.
that is treated in the same manner as 5 for 4 stock. So what does this 5 for 4 mean?
Split. 5 for 4 means split basically.
No, but how did they relate 25% to
Well,
5 for 4?
is it 25 or 20?
25% stock dividend
25% they are writing as 5.
for 4 stock split, and the strike price becomes 4 to 5 of its previous level.
Yeah, I think we can check the math behind it. Okay. So just for
Yeah,
the sake
I
of
am not
simplicity,
understanding the maths.
okay. So
Hello,
just for
sir.
the sake of simplicity, let's assume we have the initial price is 100. Okay. And then 25% is what the
Stock
dividend,
dividend.
stock dividend.
So what does this mean, sir? First of all,
Okay. Okay. Just checking. So see, it means that you are paying the dividends. Yeah, it's now it's clear. You are paying the dividends in the form of stocks
stock. Yeah.
rather than cash. Okay.
So
So
if I
what
have
you're
100
doing,
stocks,
yes, if you
I
buy
will get
100
25 more.
stocks, exactly. If you buy 100 stocks, you are getting 25 more. So now each shareholder has actually 125 stocks, but the value of those stocks is same as the previous 100 stocks, correct?
Yeah.
So it's very simple. So the ratio is basically nothing but 125 by 100, which is 5 by 4. That is why 5 for
Okay,
4
okay.
stock split. Okay.
And
So it's
suppose, sir,
quite.
what if I have only one stock? Then in that case, how will they pay me 25%?
Yes.
One
So
for
again, if you have only one stock, then see based on the structure, I think for fractional shares, they should have some kind of mechanism. I'll have to check this. What happens if you don't have that many share for which 25% is an integer, right? That is our problem, right?
Mhm.
So I think some approximation can be done. Maybe if you have one, then there is no option. You'll not get anything because the closest to 1.5, 1.25 is one only. Approximation is possible, but I don't think it should be ideal. I think the investors will not be very happy in this case. So I think you will be treated as though you have 1.25 shares. Okay, the amount is actually 1.25 shares, but how the allocation process is done, that needs to be checked. Okay, so
Okay, got
just
it.
after this session, just give it a short once. Okay, or you ask ask this on the LMS. I'll do my research and I'll let you know what
Okay.
exactly. Okay, I
I
don't
just
think
had the
approximation is a
doubt.
good idea. Yeah,
Yeah, I got my doubt was that 5 for 4 I was not understanding.
5 for 4 is
That
clear,
got
right?
cleared. Yeah, yeah,
Yeah,
yeah.
this is clear, but
And
still,
sir,
I
one
think
more.
this is also very interesting that you have asked that, what happens if you only have one share, then what will happen for the stock dividend? So this is also very interesting. In maybe they will give you that 25% in cash. That is also possible. The fractional amount. Let's say if you have something, some number of shares after if you add 25% to that, maybe you are getting say 12.75, hypothetically I'm saying. So
Hmm.
maybe you get the so two more shares. I mean, the number of integer shares you are getting, but the number of decimal shares maybe you are being compensated for with cash. That is also possible. But again, whether it is done like that or not, we'll have to check, because that will disturb the 5 for 4 stock split idea, entire idea. The 5 for 4 stock split idea will only work if everyone is getting say 0.25 more shares. One more thing is possible, I think. Just again, theoretically, I'm saying if I'm the company and if I have to execute this process, again, this may not be done in practice, but mathematically, what I can do, I can pool all these fractionals and I can buy back those fractionals. The company will buy back those fractionals and the company will pay cash for those fractionals. So then this 544 will be executed. Okay. Although the equity of the company will go down a little.
Okay.
That is possible.
And sir, one more thing.
Yes.
In the commission section,
Mm-hmm.
in the I think so like lesson objective D,
Mm-hmm.
in commission section there was while watching the video, no, I'm
Mm-hmm.
not able to recall completely the terms,
Mm-hmm.
but what they were saying, like you were
Mm-hmm.
saying,
Mm-hmm.
that instead of exercising the option, if it
Mm-hmm.
is maybe not profitable for the long position of the holder,
Mm-hmm. Mm-hmm.
he may sell the option. So what does
Correct.
that mean?
Actually,
How an option
that
is
is the
sold?
practice. See, that is the practice. See, in secondary markets, generally, when even when we talk about futures and futures, if you remember, futures, the contract is very rarely settled by taking delivery. The position is always offsetted and continuous trading takes place. So in the secondary market, see, it's the primary market. It's not a primary market. We are still, if we are dealing with the exchange and the other parties, we are actually in the secondary market. In the secondary market, the price of option will continuously change, right? Up, down. Every day, the price of option will change. So rather than exercising the option, waiting till the last day to exercise the option, most of the traders, okay, whether they are hedgers, speculators, or arbitrageurs, most of them actually buy the option and then sell the option at a particular price, which offsets their position, just like you do it with any instrument. That is that. Okay, so rather than exercising it, let's say you bought the option for $5.5. Okay, and after some time, the option is still out of the money. Let's say, okay, the option is out of the money after of 25 days, and the option will still have some value. The option will have a value of, let's say, $1.2. Okay, so obviously, if the trader waits and chooses to exercise and waits till the last day, then maybe the option will be out of the money and the trader will get nothing. So the trader, what the trader does, that okay, let us sell it for a lesser price, $1.2. Now you may ask that if the option is out of the money, why the option is even having some value? We will discuss that part, because there is some time value also associated with the option. You have an intrinsic value, you have a time value also. So rather than exercising this option, which will give the trader a zero payoff, it is better to go for something, right? $1.2. That's the idea. Okay, Parth? Clear?
Okay. So in general, like they just sell it off, like
In
anything
general, they
else.
sell it off. Yes, in general, this is what happens. In general, this is exactly what happens. Most of the traders do this only. They don't wait for settlement. Okay, by delivery. Got it? That's the idea.
So why
Okay.
does someone buy it?
Why does someone?
Buy it.
Again, perception. See, it's the same question
Okay,
which we have
got it.
answered. Again, it's about perception. Okay. And see why? Because if now the option is being available for even less, although less time is left, but it is being given for quite a lesser amount. Maybe this person feels that this person may feel two things. Either the stock price will rise, or even if it does not rise sufficiently, it will fluctuate. The call option price will fluctuate a little bit, and maybe I can sell it for 1.3. Who knows? Maybe this person is here for getting a very small profit. Got it? So that's the idea. And at any price, the number of buyers, I mean, at equilibrium price, the market price which is there, the number of buyers should be equal to the number of sellers. Of course, as the number of buyers increases, the price will push upwards, as the number of buyers decrease and the number of sellers increase, the price will go downwards. One insight that Ujjwal had given when we were discussing that margin part also, just an FYI, CFTC regulation is only applicable for US entities. So day 5 is applicable only for US region. Different regions has different regulations, and this is not a generalization. Okay. For example, for EU, you have to check EMIR. Okay, not CFTC's regulations. Okay, fine. Thank you so much. So with that, we'll just end this lecture. Thank you very much. Bye.